was growing up in Philadelphia, we had three big TV stations, NBC, ABC, CBS. Sure, if the rabbit ears were pointed correctly, we could get Channel 29, whatever that was, and PBS. But if we were an advertiser trying to reach a mass audience, well, you went with one of the big three networks that are affiliate, Westinghouse at that point. You could also place ads in magazines or newspapers. We had the Inquirer and the Bulletin with its catchphrase, nearly everybody reads the Bulletin. Both had some real reach. We had a few radio stations, too. Then cable came along, offered much more targeted programming, and took market share from everyone else. Over the last 25 years, we've seen the rise of the internet, and gradually all sorts of digital operators have pried ad dollars from old media. Unlike everything that came before, the web lets you reach a targeted audience, truly targeted, and you actually know whether your ads are being read or not. I saw this transformation coming, which is why I started TheStreet.com 25 years ago. Sure enough, the internet changed everything. Newspapers fell apart. I just got a charity appeal to give money to the nonprofit owner of the Philadelphia Inquirer, basically to keep it going well. The Bulletin folded years ago. Most of the major newspaper chains have been destroyed. Terrestrial radio is of little consequence for many advertisers. Magazines fighting for their lives. Some are charities. Television's hurting, especially cable. Heck, even major online media operations are struggling here, because while the web has been a gold mine for those who can reach both segmented and en masse consumers, that gold mine is now controlled by the new big three, Alphabet, Amazon, and Facebook. With this latest quarter, they've pretty much become the only game in town. Every town. Their digital takeover happened practically overnight. Only a couple of years ago, there was still a widespread sense that a bunch of web channels would be winners. A bunch would be important advertisers. Had Pinterest, Snap, Twitter, Yahoo, Yelp. They all had tons of eyeballs. Most newspapers have disappeared, but the ones with great digital exposure were thriving, like the New York Times, at least for advertising. And you had more specialty sites for reviews. It just all seemed to be coming together, especially sites that catered to travelers. Finally, though, the last bastion, you still had a ton of advertising centered around live sports programming on TV. Almost all the big games, all the campaigns, they started with the kickoff and the jump ball. But then the coronavirus came along and shut down all sports. Without any games, well, there's nothing to advertise against. Big digital platforms, Yahoo was subsumed by Verizon Media. Maybe it'll exhume it someday. Yelp, we don't need no stinking Yelp. Restaurants are all closed. Travel, dead industry. Barry Diller, the chairman of Expedia, says they'll only spend $1 billion in ads this year, down from $5 billion last year. Airbnb's gotten hammered. Revenue's down 50% year over year. Big layoffs. Those were huge sources of ad spending, but not anymore. How about the New York Times? Okay, today the gray lady predicted a stunning 50 to 55% decline in ad revenue. Now, the stock still managed to rally because they are doing unbelievably well with digital subscriptions. But it was a grim advertising forecast for the rest of the industry, caught my eye. This morning, Citigroup downgraded Snap to a sell, said the ad estimate's too high. Snapchat? I don't know. Most surprising, the stunning drop-off in Twitter and Pinterest. Before COVID, Twitter was a great place to launch events. Now there are no events, and the quarter was unloved. I thought Pinterest owned a lot of niche verticals, lots of leisure activities. But last night we learned that their ads had just grown shockingly weak. But you know who had truly blowout numbers? Facebook, Amazon, and Alphabet, the parent of both Google and YouTube. All three took a massive amount of market share. They're selling more ads for everything from consumer packaged goods to deluxe items to sheets and towels and furniture. The big three always owned small business. Now they also own all business, consumer packaging. That's why their stocks are strong. Facebook's been a dominant player for a while. Same goes Google with search. But I was stunned by the strength of YouTube and Amazon's advertising business. It came out of nowhere. They've now pulled away from the pack. Advertising is, once again, a three-horse race, just like when I was a kid, just like when it was just NBC, ABC, and CBS. Today, we have the same thing, only it's Facebook, Amazon, and Alphabet. Let's go to Torsten in Connecticut, please. Torsten.
Hey now, Jim. Thanks for taking my call.
Of course.
My question's about Mercado Libre, MELI, the e-commerce platform in Latin America. I'm intrigued that they diversified past their marketplace and the eBay offering they used to have into Mercado Pago, the payment system, which now actually other retailers are using. I got in at 548 last night. They crushed market expectations. They're now at 740. I'm wondering if I should ride this out or sell and buy.
I know this sounds, I'm going to give you a twofer. I know this sounds wrong, but both Shopify, which is up huge, and Mercado Libre, which I was an original investor in, they're fabulous. And no, up 121 is a sign not of something you should bail. That quarter was great. It's just being revalued. You got to hold on to it. Wow. Let's go to Eric in New York. Eric.
Hey, Jim, how's it going?
I don't know, man. These are long days. How are you doing?
All right. I watch you every day with my wife. Can you shout her out quickly? Her name is Giselle.
Giselle, how you doing? All right?
All right.
Okay.
Yeah. Well, I got a question about a Northeast staple, Dunkin' brand. Last week, quarter one earnings and revenues beat estimates. And earlier this week, they announced a new partnership with Uber Eats on top of their existing partnership with Grubhub. So what do you think of Dunkin' going forward?
Look, I recommend this stock for a very long time, and it's a good company. It is. But Starbucks is in at the cusp of a major, major turn. And I need you to go into Starbucks, not Dunkin'. I do like them both, like I said, but Starbucks stock's been knocked down. They've both been knocked down, but I think Kevin Johnson's got some really special initiatives coming, and you want to be there for that one. All right, including Beyond Meat, by the way, which they have a great relationship with. You'll hear from later. All right, it's a digital takeover. Alphabet, Amazon, and Facebook have become the only advertising games in town. What's more Mad Money ahead, including my earnings exclusive with, as I just mentioned, Beyond Meat, Mattel not doing that well, Waste Management, I don't know. Stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.